So the economy is weak. You can see it in the economic data. You can see it in the earnings. And so now it's showing up in the foreign exchange markets. It's showing up in the stock market. Overall, the dollar was relatively flat on the week. Gold had one big down day yesterday. It was down like $50 or something. It recovered about $20 today, so it finished the week down 0.5%. So not that much. That knocked the gold stocks down about 2.5%. So I think the sentiment is turning. I think there is some buying coming in because gold stocks are value stocks. They're defensive stocks.
Welcome to Smart Money, where we dive into the latest economic trends and market movements. Today, we're seeing clear signs of economic weakness reflected in data and earnings reports, impacting foreign exchange and stock markets. The dollar held steady, while gold saw a volatile week, dropping $50 before recovering $20, ending down 0.5%. This led to a 2.5% decline in gold stocks, hinting at a shift in sentiment as investors seek value and defensive plays. With speculation growing that the Federal Reserve might cut interest rates in September, renowned economist Schiff views the recent dip in gold prices as a buying opportunity. The economic landscape shows a cooling trend, with consumer spending slowing, especially among low and middle-income groups. The upcoming Fed decisions and market reactions are critical points to watch as we navigate these uncertain times. Now, let's jabber into the details.
The economy is weak. You can see it in the economic data. You can see it in the earnings. And so now it's showing up in the foreign exchange markets. It's showing up in the stock market. Overall, the dollar was relatively flat on the week. Gold had one big down day yesterday. It was down like $50 or something. It recovered about $20 today, so it finished the week down 0.5%. So not that much. That knocked the gold stocks down about 2.5%. I think in the face of yesterday's sell-off, when gold was down about 1.5% in one day, the gold stocks weren't down that much. They were down 2.5%. So, I remember days that gold was down 1.5%. The gold stocks were down 6%. So I think the sentiment is turning. I think there is some buying coming in because gold stocks are value stocks. They're defensive stocks. They should be bought. But, I noticed a lot of the stocks that I own that are defensive in our portfolio. Tobacco stocks, British American Tobacco made a 52-week high today. Consumer staples, Unilever, another stock in our portfolio. Good earnings, up, I think, about 8% in the last 2 days. Closed the week with a new 52-week high. So some of these stocks that we have in our managed accounts and our mutual funds that are defensive in nature were hitting new 52-week highs. That's why even though gold stocks got beaten up pretty hard this week, and we have gold stocks in my value fund and my value fund and my dividend payer fund, both those funds outperformed on the week. Both the funds were positive, even as the S&P went down, because of the gains in the defensive stocks, as we're getting this rotation out of momentum into value. Now, the question is, how much longer is the Fed going to sit on the sidelines and allow this scenario to play out? I don't think much longer. I think there's a lot of pressure building now on the Fed to cut rates, and maybe not even a 25 basis point cut. Maybe we'll get a 50 basis point cut at the next meeting. Because if they don't cut at the next meeting, now you're really kind of getting closer to the election. And there may be some pressure on the Fed. Oh, you can't cut. This is just political. Of course, if they cut now, I think that's political too. But I do believe, as all Fed chairmen do, they owe their allegiance to the last guy that appointed them, which in the case of Powell is Biden. Even though Trump initially put him up on as Fed chair, Biden renewed his term, and the Democrats are the incumbents. And even though Biden isn't even running for re-election. Harris is. I think he's still a team player, unfortunately, despite all the talk about Fed independence. So I think the time for Powell to do a politically opportunistic rate cut is at the very next meeting. And I think he has enough data, this phony data, that he can hide behind to try to justify the rate cut. He can say that, the inflation rates are down, they're down 2.5%, which, that's close enough. It's not quite 2%, but, we're almost there. We're on a glide path. He could see the uptick in unemployment, the increasing number of weekly claims and all the other weak data. And he could say, look, we need to be get ahead of this. We need to, move with the rate cut. So I think there's a very good chance we'll get that rate cut, and maybe that will change the dynamics in the market. But I think without a rate cut, if Powell keeps claiming that, no, we're going to be vigilant, everything is great, the economy is strong, we're going to keep rates high.
The Japanese yen saw a notable rally from its 30 to 35-year low, strengthening significantly to close the week at 153.34 yen per dollar. This movement marked a sharp reversal and took a toll on Japanese stocks. The Swiss franc also saw gains against major currencies, while the Australian dollar weakened substantially, dropping consistently throughout the week. This decline in the Australian dollar, which is often tied to global economic growth due to Australia's commodity exports, suggests growing concerns about a potential global slowdown. Investors are increasingly shifting from risk on assets like the Australian dollar to the yen, indicating a broader expectation of a recession. This shift is part of a larger trend as investors move away from the soft landing narrative and brace for more significant economic challenges. Manufacturing data has been weaker than anticipated, with the sector remaining in a recessionary state the Biden presidency. This has been highlighted by recent reports that consistently fall short of expectations, contradicting claims of a manufacturing boom. As the economic landscape softens, speculation is mounting that the Federal Reserve might consider lowering interest rates, this possibility fueled by a cooling economic environment and softer than expected inflation reports. Economist Peter Schiff has pointed to the recent dip in gold prices as a strategic buying opportunity. He emphasizes that gold stocks have remained resilient despite fluctuations in the broader market. A rate cut could lower the opportunity cost of holding gold, making it a more attractive investment and potentially weakening the dollar, which would further support gold prices. As investors closely watch the Federal Reserve's next moves, any signal towards a rate cut could lead to increased volatility across financial markets, impacting everything from gold prices to stock valuations. The evolving economic landscape and the actions of the Federal Reserve remain crucial focal points for market participants as they navigate these uncertain times.
We saw a rather sharp rally in the beaten down Japanese yen. The Japanese yen was sitting at, 30 to 35-year low or something like that. The yen got up to 161. And when I say up, I mean down, because you could buy 161 Japanese yen for a single dollar. And again, you haven't been able to buy that many yen for your dollar in about 35 years. And we had a big rise in the yen. I didn't hear anything about Bank of Japan intervention. It's always possible that that was going on behind the scenes. I don't know. But the yen closed the week at 153 3/4. That was a huge move for the Japanese yen. It took some toll on Japanese stocks. They got beat up pretty bad with a strong yen. From the perspective of a U.S. dollar investor, it was probably a push, right? The yen went up, Japanese stocks went down. So in dollar terms, there wasn't much action, but there was certainly a lot of action in Japan. But at the same time that the Japanese yen was moving up, the Swiss franc also had a pretty good gain against the euro and other currencies. And on the flip side, the weakest of the major currencies was the Australian dollar. Just got clobbered pretty much relentless, down every day, except it gained a little bit back today. I forget what it dropped on the week, maybe 2-3%, but that's against the dollar. Much bigger drop against the Japanese yen. And I think a lot of the trading was spread trading. I think that people were unwinding some bets that they had made, maybe long the Australian dollar and short the yen. And the reason this is significant is normally when you see yen buying and Aussie dollar selling, it's because investors or traders are looking for a slower economy because the yen is perceived as a safe haven, even though there's really not much safety in the Japanese yen at this point, but it is still a risk off a kind of currency, a funding currency and a risk off currency. And the Aussie dollar is more of a risk on because Australia, their main export is raw materials, iron ore, energy, stuff like that. That's the kind of goods that, you need when your economy is strong, particularly the Chinese economy. China imports a lot of raw materials that it incorporates into its manufacturing process. And so if you think there's going to be a global slowdown, there's going to be less demand for goods, raw materials to make the goods. And so you see weakness in the Australian dollar. What's happening here is investors are starting to price out this soft landing hypothesis, and they're bracing for a hard landing. And a hard landing meaning a recession. Now, of course, I think we're in a recession. Certainly manufacturing has been in a recession pretty much for the entirety of the Biden presidency, which is why it makes me so mad every time I hear Joe Biden talk, to the extent that he can talk. And he talks about the booming economy, how great manufacturing is. Of course, Trump said the same thing, and it wasn't true when Trump said it, and it's not true when Biden says it, but manufacturing has been terrible. And all the manufacturing data that came out this week was all bad, right? Everything was worse than expected. So the manufacturing's been in a recession. I think the whole economy is in a recession. It's just not officially in one because the numbers aren't accurate. But I think that investors are bracing for an official recession.